Indian corporate balance sheets are about the healthiest in at least 10 years, if not more. That's the verdict from the rating agencies. Rating agency CRISIL's score for H1FY23 shows that the number of upgrades were 5.5 times the number of downgrades, with 569 upgrades and only 103 downgrades. For rating agency ICRA, the upgrades are 3 times the number of downgrades, 250 upgrades and 76 downgrades. So what accounts for this extraordinary showing and what is the future looking like? I have with me two experts. Somasekhar Vemuri, the Senior Director and Head Ratings Criteria, Regulatory Affairs and Operations at CRISIL, and Jitin Makkar, the Head Credit Policy and Senior Vice President at ICRA. Jatin and Somasekhar, thank you very much indeed for joining us. Mr. Somasekhar, first to you. Is this the best ever ratio you have seen or was 2006-07 even better?
Good morning, Lata, and happy Durgashtami to all your viewers. In the last decade, if I look at it, when we've had a sizable number of companies in our portfolio, clearly this ratio seems to be the highest. But if I were to look at 2004, 5 or 5, 6, the ratio may have been even higher. But I would like to highlight that at that point in time, the number of companies in our coverage was much, much smaller, maybe about 300 odd companies compared to the 6,800 companies that we cover now, or even for the last decade where we used to, cover a fairly sizable number of companies. So it's not a like-to-like kind of a comparison, but in the last decade, I can say that this is amongst the highest. And in terms of the reasons, very clearly, it is on account of strengthening demand and realization. And if you look at one metric, EBITDA, over a 3-year time frame, the companies we've upgraded have seen a 25% increase on a CAGR basis over these 3 years, compared to 12% for the rest of the portfolio. And gearing also is something which has been strengthening on a secular basis. And these upgraded companies have actually seen a gearing reduction of 0.4 times compared to 0.2 for the rest of the portfolio.
Okay. So the big argument is that they don't even have much debt. They are seriously deleveraged. So would you say, therefore, that the good run can continue?
I think very clearly when we look at, infrastructure, for example, it's accounted for almost 35% of the upgrades that you said, infrastructure and the large real estate companies. And there we see that this is largely a domestic story decoupled from what is happening on the global macros and the headwinds which are there. And hence we believe that as long as the government's thrust on infrastructure spends continues, it looks like it is going to continue. We would see a fairly good run to continue here. Having said that, given the headwinds, I mean, there are certain sectors, especially the export-driven sectors, where we would see moderation in terms of their performance. Textiles, pharma, IT, for example, could see some cash flows getting moderate.
I will come to the likely downsides in just a minute. Let me get Jitin into the conversation. Jitin, would you largely concur with what Somasekhar is saying? Is it also infra which is pushed up? Which are the sectors that made the ratio look so good at your end as well?
Yeah, hi, good morning. Yes, to a large extent, the trend lines have been very similar across the rating agencies in FY22 as well as in H1FY23. Yes, in terms of sectors, what we've seen is that at least in our portfolio, the real estate sector, textile sector, and construction and engineering sectors have been the big sectors where we've seen a bulk of the rating activity on the upward side. Other than these sectors, there have been other sectors also where, like the financial sector, where certain entity-specific rating actions have been taken. But the reasoning behind these upgrades, if you were to look at the real estate sector or the textile sector, specific entities which completed their projects in the real estate space, in the commercial office space, in the warehousing leasing space, these were the entities which were seeing upgrades. So what I intend to say is that these were not broader sector level tailwinds that were driving upgrades in the real estate sector, or for that matter in the textile sector. But yes, the construction sector, we've seen order books swell, and that's been a story by and large which has been pushing up upgrades in the construction sector because of sector related factors. In most other sectors, there have been entity specific attributes that have driven upgrades.
Okay. Well, even for real estate, there is a sector tailwind. It does look like broadly demand has gone up, especially after work from home. or maybe the long night also ended for real estate. But I'll come to that in just a bit. Somasekhar, you began by pointing out to some clouds on the horizon. You said that export companies which are dependent on exports could see a thinning of cash flows. We just heard from Bajaj Auto. Their domestic sales are good, but exports have really gone for a toss, and that's a large brand. Do you see just lower cash flows or actual trouble with paying back, especially if people have dollar loans?
That clearly depends on how much of debt which is sitting on balance sheets. For example, if you look at the IT sector, yes, we do anticipate moderation in cash flows given what is happening. But the IT sector has very limited debt and sitting on piles of liquidity. So there we don't see or anticipate that kind of pressure. Similarly, for pharma also, by and large, most companies have very low debt on balance. So it really depends on company-specific factors where you have very large amount of debt which is there. If that is the issue, then you could see some pressures. But as I mentioned, earlier, balance sheet is something where we have seen a secular trend, especially which accelerated during the last 3 years. I mean, in terms of the reduction in leverage on the balance sheets. So that is something which has built in good amount of cushion and headroom for quite a few of these sectors to tackle the headwinds going forward.
Okay. I'll just come to your guess on how do you see the ratings, buckets, upgrades and downgrades moving from here on. But to the same point, Jitin, my colleague Sonal Butra is just in the process of doing a research on how companies are exposed to dollar loans. And she points out to several companies whose exposure to Europe, percentage of export earnings exposed to Europe, is fairly significant. Aarti Industries, Anupam Rasayan, Atul, Clean Science, Deepak Nitrate, Naveen Fluorine, Virati Organics, etc. Do you sense that there can be rating pressure or leverage pressure, gearing pressure on companies exposed to Europe?
Yes, there could be in situations where the exposure to Europe is quite high, or for that matter to US, where again recessionary pressures have been taking. There's been a lot of talk about recession in the global markets. But yes, we see that even in the past, when there have been global concerns, overseas demand concerns, entities have managed to find a way to find alternate channels of demand. Supply has shifted. Manufacturing has been oriented towards various other customers in other geographies, including India. So yes, these are looming risks. But yes, entities have shown that they're resilient and they should be able to course correct and mitigate some of these concerns.
Okay. Well, there are also companies with large Forex loans, isn't it, Somasekhar? Do you fear that there can be issues because of dollar loans?
It depends on whether they are hedged or unhedged, and as per even a recent RBI study which they've done and the governor spoke about, I think the overall size of clearly unhedged foreign currency exposure where there is no even natural protection through either exports or through ability to pass on. That's a fairly limited. About $22 billion is a number that was quoted out of the total about $180 billion of foreign currency debt which is there. So it is a much more manageable position now compared to, let us say, what was the situation, the taper tantrum in 2013-14.
Fair point. Okay, then we'll ignore if there are no clouds, why should I look for them? What are the most buoyant sectors, Jitin?
I think our visibility is there on the road sector and the construction sector, which has linkages with the road sector. Real estate sector, you mentioned that your research suggests that demand has been growing well. But yes, real estate is a story which has to be looked at in two slices. There are key players which have been doing exceptionally well, but at the same time, there are other players, smaller, less credentialed players, which have seen a big slowdown in their demand. But yes, there are these demand drivers coming from real estate and the road sector, which will have these positive rub-off effects on the related sectors like steel and cement and construction. So amongst the sectors which will see buoyancy, we would want to pin our hopes on the construction sector, road sector to a large extent.
Okay. Somasekhar, best sectors for you. But more importantly, I also wanted from you the downside sectors. Rate hikes are underway in India and more are expected. Let us assume the rate peaks at 6.5 for the sovereign, then it could peak at 8.5 for a lot of corporates, or even more if they are not AA. So both buoyant sectors and sectors you would worry about.
So clearly, some of the sectors which were very, very badly beaten up during the pandemic years and now are seeing, very robust revival. Hospitality, airport operators, to name a few, and infrastructure sectors such as, toll roads, renewables, HAM road projects. Those are again very clearly sectors where we do believe that there will be a good amount of buoyancy. On the other hand, caution will be, largely in sectors such as agrochemicals, textiles, and pharma, where we are likely to see moderation in cash flows, given that there is a demand pressure from the end user markets for the export-oriented ones, and in the domestic ones, they are not able to fully pass on the impact of elevated commodity raw material prices onto their end product prices. So those are the sectors which could potentially see some degree of downward pressure on in terms of the credit profiles. Having said that, I mean, the balance sheet is something
who is not able to pass on?
For example, if you look at agrochemicals and dairy and education services, these are a few of the sectors where we believe that the costs have started going up and they're not able to fully pass them on to their end consumers. So there could be moderation in cash flows. Having said that, as I said, the balance sheet is something which also comes into play when we look at the overall credit profile, not just the cash flows.
Well, just one word, Somasekhar, in your report, in your press release, there was a statement saying that there isn't much capex and that is why infra is safe. There's no competition. But more generally, no capex not much capex doesn't sound very positive from an economic growth angle. Is there a worry? Not enough capex?
Yeah, I think, if you look at, again, the headwinds, you have very high inflation, very high interest rates. The global economies are likely to go into a recession. So while we have noted that, overall capacity utilization has been trending upwards, even as per the RBI's survey, OBICA's survey, it stands at about 74%. It is something which we believe is likely to kindle the animal spirits, as we say, but the headwinds are so strong that probably quite a few of the corporates are in a wait and watch mode.
Okay.
In the segments such as which are linked to PLI, we do anticipate that the capex will continue.
Okay.
And also in the infrastructure sector, which is where the government is significantly focused, we expect investments to continue.
Okay, thanks. We're absolutely out of time. One line from you, Jitin. Would you worry about capex?
Depends if you are in a space where the capex is going to give you revenues like roads and construction, then you're not worried about capex at all. But yes, in the rest of the pack, the manufacturing space, still there is slack in capacity. So if demand does not pick up and you go for capex, which is unlikely, then of course balance sheets get stretched and that exerts credit pressures.
Fair point. We'll have to leave it at that. The story so far is very good. That's the word we have from CRISIL and from ICRA. Thank you very much, Somasekhar and Jitin. Just a word, the rupee is back under pressure, closer to the 82 mark, and bond yields are also closer to the 7.45. So all the good work of last week has gotten wiped out a bit. We wrap up on Bazaar on that note. Trading ideas coming up for your chartbust.